So for the past 13 years, I've built a real estate portfolio valued over $300 million. And this portfolio has not only made me extremely wealthy, it provides me enough cash flow to support my lifestyle so I don't need to work a 9-to-5 job ever again. Now in this video, I'm going to break down the most common real estate investing methods and show you which one is the best to be doing to going into 2025. We're going to go over flipping houses, buying single family rentals, the BRRRR method, short-term rentals, and multifamily. Now, and the criteria we're going to use is the following. Number one, short-term income. How much income do you make in the first few months after doing a deal? Number two is cash flow / passive income. How much residual income do you make over the next few years after buying or closing on a property? Number three, wealth building opportunity, long-term appreciation. So as you hold this property, is it going to make you wealthy so you can retire? Because ideally, you want to be earning strong cash flow today and be building wealth so you have a multi-million-dollar net worth, so you have a real estate empire over time. Number four is capital needed, the capital requirements. So we talk about how much capital you need to do your first deal and how much capital you need to keep in a deal. I know so many people that have $50,000 or $100,000 to invest, and if you do something like single family rentals, that will only get you like 1 or 2 rentals. Versus there are other ways to invest in real estate where you get your cash back quicker so you can go on to the next deal and the next deal and actually scale your portfolio. Number 5 criteria is risk, because what good is making a bunch of money if you lose it all? Ask me how I know. I'll save that for another day. Now, if you want the full story, I'll tell you where to find it at the end of this video. Number 6 is tax benefits, because if you own a successful business or you're earning 6-figure income, you're likely paying a lot of taxes. Now, you can reduce those taxes with real estate, but not all strategies are created equal when it comes to taxes. So let's get into it. So strategy number 1 is flipping houses. So in a 3-year span, I flipped over 3 dozen houses, so I have a good amount of experience here. Now, with all the criteria, short-term income is good, right? Because you're making $25,000 to $50,000 per deal. That's pretty nice. Cash flow, passive income, none. So it's a very poor rating because you don't really make money when you buy. Building wealth, long-term appreciation, none, right? Because you're only holding it for 6 months, so it doesn't really give you a long time to appreciate it. Capital needed, mid to low. So either you need $25,000 to $100,000 of your own money, or you can raise it from hard money lenders or private investors. Tax benefits, low. Because if you sell the house within a year, you can't get depreciation. And then, of course, you're taxed at the regular capital gains tax. So no real tax benefits for flipping houses. Risk, in my estimation, high. Because if you're using a hard money loan, like if your project doesn't sell within 6 months, the fees and penalties of hard money loans can push the projects into the red. And there's mistakes you can make, fairly easy mistakes that'll cost you a lot of money. For example, you can underestimate or overestimate the ARV incorrect. You can get that wrong. And then your construction team has to finish on time and on budget, which are often hard to do. So many flippers find that they end up making less money than they think for many of these reasons. Scalability is low because it's tough to scale. Most investors can't handle more than 1 flip at a time, and if the average flips take 6 months, you can do 2 flips per year, generating $50,000 to $100,000. Now, not bad, but what if you want to make more than that? What if you make $500,000? That's tough to do with flipping. Now, bottom line for me is that the flipping can generate a meaningful amount of cash, chunks cash generation. I like that. If the average flip makes $25,000 in profits, you only need to do 4 per year to make $100,000 before taxes. But it's a lot of work. And if you're not fixing, buying, or selling houses, you're not making money. And that's not passive income. So that's my problem I have with flipping. Now let's talk about the single family rentals, also known as the BRRRR method. Now, when you hear about real estate investing in the news or on TV, this is probably the strategy they're talking about. BRRRR stands for buy, rehab, rent, refinance, and repeat. And it's where you buy a house, fix it up, find a tenant, refinance it, and pull your initial money out, and then you repeat the process. So let's see how the BRRRR method stacks up. Short-term income, bad, right? Low. No profit when you buy the property. Cash flow, passive income, low. You make $100, $200 per month, and most people I know with rentals are breaking even. And this is problematic, right? If you want to earn $10,000 per month in cash flow to replace your income, you need to own 50 to 100 houses to make that happen. And as someone who's flipped 36 houses in 3 years, let me tell you that owning 50 houses is beyond a full-time job. Let's talk about building wealth, long-term appreciation. That's good. because you can force depreciation when you buy and renovate the property, and the real estate goes up in value every year, assuming you buy in the right location. Capital needed, mid to high. Now, these deals don't have enough profit for you to raise capital. And the average home in America is about $400,000, meaning you need about 25% down, $100,000 to buy a rental. Now, you can buy a cheaper home, but if you include fees, deposits, you're still looking at about $25,000 to $50,000 down that you won't get back until you refinance and or sell the property. Tax benefits, middle. You do get some benefits from depreciation because you're holding it typically for longer than a year, but residential properties depreciate less than commercial properties because you can't do a cost segregation, and so therefore the tax benefits are not quite as high. Risk, mid to high. Now there's two main risks with rentals. One is market risks, especially if you're holding this for greater than a year. If you need to sell your property, you're relying on the market. Now if the market's down, so are the rentals. And rentals didn't perform well in the last Great Recession of 2008. Many people lost their houses and rentals during this time because the market tanked for several years until it recovered. So single family houses aren't as recession proof as I would like in some other asset classes. The second risk is you have a single tenant risk. If your tenant moves out, you're on the hook for the entire mortgage until you can find a new tenant. Now, this is especially stressful if you have a bad tenant that damages your property, so it can't be rented a few months and then you have to pay for the repairs. Scalability is low. It's difficult to scale because your money is tied up until you fix it up, rent it, and refinance the property. That means it can take about a year or so to get your initial investment back, so you can only buy one property per year. You also need a lot of these things. If you do the math, you need a lot of rentals to replace a six-figure income. Like we talked about earlier, if your property generates, let's be generous, $200 per month in cash flow, you'd need 50 rentals to make $10,000 per month. That's a lot of rentals. Have you thought about that? And then finally, there are some lending limits, right? So your ability to scale is going to be a little bit limited because they're considered residential rentals, and most lenders following Fannie Mae and Freddie Mac guidelines will allow financing for up to 10 properties per borrower. Now, there are many other banks that set their own limits, and they're typically lower, they're around 4. So bottom line, I like the BRRRR method better than flips because you're at least starting to build some passive income. You're starting to build some kind of wealth. It's less transactional than flipping, but it's still hard to scale because you need a lot of them to replace a six-figure income. Let's talk about short-term rentals. Now, this is a popular strategy that took off in 2020 when the pandemic led to massive surge of Airbnb bookings. Let's look at each of our criteria. Short-term income, bad, right? Like rentals, there's really no profit or cash when you buy the property. Let's talk about cash flow or passive income, mid to high, actually. From what I've seen, most good short-term rentals can earn between $10,000 and $2,000 per month. That's pretty cool. However, the profitability has been declining over the past several years. And as more investors enter the market, like I have a friend in the space who's got a pretty big portfolio, and he's reporting that over half his rentals are now at or below break even. So I don't like the profitability, the cash flow trend in the STR space. All right, what about building wealth? Long-term appreciation. It's pretty good. Again, it's the same thing for rentals. If you're holding real estate over the long term, you have now the ability to build wealth. What about the capital needed? Mid to high. It's very similar to rentals. They're slightly better than rentals because the income is higher. Some banks are actually treating it more like a commercial loan, which is good, right? You can actually get more loan proceeds. There's less limits on how many of these you get. Again, you do need to come up with a down payment on these things, and it really depends on the type of short-term rental you have, how profitable it is, whether you can actually raise that money from investors or not. And if you can't, you're going to have to come out of pocket yourself. The tax benefits are middle. Just like with traditional rentals, you get some benefits and depreciation because you're holding it for longer than a year. Your tax treatment is slightly better, but again, you're not doing a cost segregation like you are in commercial real estate, and so you're not getting that depreciation in the first 5 or 6 years. The risk, for me right now, currently the market, I would have said a couple of years ago, I would have said relatively low because of the cash flow that you're making, but right now, I feel the risk has gotten a lot higher because of the decline in cash flow. So this is what I don't like about that. So, the scalability to me is about middle, because if you buy profitable STRs in areas that are not oversaturated, which is a risk, but if you can, you don't need a lot of properties to replace a six-figure income, right? You don't need 50, you might only need 5 or 10 of them if you play your cards right. Now, bottom line, I do like the strategy better than flips or traditional rentals, but you really have to know what you're doing. You really have to buy in the right market. And you can, because the cash flow, if you buy right, is better, there is a possibility of raising capital for it, that you have better professional management for that. It does cost, they take 25% of your income, so it is a pretty big cut of your rental income, but it starts to get more profitable and it starts to get more scalable. But why do rentals and STRs when you can get right into the real thing, which of course is multifamily? Now, at the end of the day, when I quit my job in 2005 after reading Rich Dad Poor Dad, my goal was to create meaningful passive income or cash flow without having to do a ton of work, and where I can truly build wealth without increasing the amount of work I had to do. Now, when I first started, like many of you watching this, I did some single family rentals and I flipped a bunch of houses. That was my big strategy. And while it did make me a good amount of money, the flipping side, I wasn't really buying, I wasn't making money. There was no, and I didn't realize this until it was 3 dozen into this stuff, that it's not passive income. And so I'd gotten into real estate to earn passive income, but what I ended up doing was buying myself another job. Now, this all changed after I bought my first multifamily property. It was in 2011. Now, let's break down how apartment buildings do in our rankings. So short-term income, high. Did you know that when you do a multifamily syndication, you get something called an acquisition fee? Now, syndication is just a fancy word. It means buying a multifamily property, any property, with other investors. Now, this fee is a fee you get from your investors for finding the deal, completing the analysis, putting it together, managing it, all that stuff, raising the capital. Now, typically, the acquisition fee is about 3% of the purchase price. Now, our average students that are working with us to get into apartment building, their average deal size is $4 million. So 3% of that is $120,000 acquisition fee at closing from day one. So that's pretty cool. Now, you can either earn the entire $120,000 on your own, or you can split it with a partner if you choose to work with one. What about cash flow passive income? Again, this is high. On an average $4 million deal, you earn about $42,000 per year in cash flow, plus $12,000 per year, what's called an asset management fee. Now, this is the average over the life of the deal, which is normally 5 years or so, right? So the cash flow, I said, is an average of $40,000. It's really a total of $200,000 over the 5 years. In the beginning, it's going to be lower and it's going to be higher at the end. And this is really what I call mailbox money, right? Because it gets paid to you every single month. And that's your cash flow after paying all your expenses and your investors and the mortgage, right? Compare that to the much lower cash flow from a single family rental, and the difference really is astonishing once you start getting a multifamily. Now, cool thing about that is instead of you needing to own 50 plus houses, all you need is 1 to 3 apartment buildings. Now, this can easily be done in 1 to 2 years. Building wealth, long-term appreciation, right? So with single family houses, the value relies on market comparables. A rental property, for example, a house that produces income is worth about the same as someone's primary residence in the same location and condition. In other words, the rental property isn't worth more because it produces income. Not so with multifamily real estate. It's a type of commercial property and is valued based on the income it produces. The more income it produces, the more valuable it is. That means I can do what's called, I can force appreciation with apartment buildings, with any commercial real estate, but I can buy it for fair market value and based on the income it has, and I can renovate it, I can raise rents, and now it's worth more than before. And I like the fact that I can control the value of the building. It makes me much less reliant on what's going on in the market, and it makes my business plan a lot more predictable. I can say I'm going to do these renovations. It's going to look like the property next door. I'm going to raise incomes and rents on that. That's raise the income and therefore the value. Now, going back to a $4 million apartment example, on top of the $120,000 acquisition fee and the $42,000 a year in cash flow and fees, $54,000 with the asset management fees, we also project about a $200,000 in profits when you sell. Now, $200,000 over 5 years, obviously you get that when you sell, but that's $42,000 a year in profit from improving the property. That's pretty cool. Now, to quickly summarize it, on a typical $4 million deal, which again is the average student deal, people who come into a program, that deal the deals I do are worth $10 million or more, but that $4 million deal can earn $620,000 over 5 years if you add it all together. So you have the $120,000 acquisition fee, and then you have $100,000 per year on top of that. So you get $12,000 asset management fee, $42,000 in cash flow, $42,000 per year in profits, $120,000 per year times 5 plus $120,000 acquisition fee. Now, these numbers are why so many investors who do flips and do rentals bang their head against the wall for a number of years, then switch to multifamily, then very quickly become financially free. And it's because of these economics of syndications. Let's talk about the capital needed. I'm going to say low to mid, because while you do need a bit of money for a deposit, maybe fly out and see the property for your education, those fees are reimbursed to you upon the acquisition of the property, meaning your capital is not tied up in each deal, and you can keep scaling your portfolio because you're actually going to be raising money from people, and all of those fees and deposits you may put down from your own money come back to you at closing. So you don't really need anything else. You're not tying up your own capital unless you want to invest your own capital. Now, because with multifamily properties, the deals are so lucrative, you can actually use other people's money and not only make money for yourself, but make a really good return for the investors. Now, remember the word syndication I used earlier. Real estate syndication is just a fancy term for a partnership where multiple investors pool their resources to purchase and manage a property, often a large commercial asset like an apartment building, something that as a private individual you would never be able to buy. Now, syndication enables you to invest in properties that, because of that, would be difficult to own on your own. Did you know that one of the first and most famous syndications was the Empire State Building? That's right, 1961, Helmsley and Malkin. I looked this up. They organized a syndication with 3,000 small investors, and they purchased this. They built this building for $65 million, or whatever. And then many of these investors bought in for just $10,000 each, a fraction of what it would cost to purchase such a property. Now, in a typical real estate syndication, there are two main roles. There's the general partners, the sponsors, operators, and then there's the limited partners, or the passive investors. Now, in the way I described it above, you would be the general partner, right? So you're responsible for finding the property, securing the financing, managing the day-to-day operations. And for that, you get paid handsomely for these responsibilities through the asset acquisition fee, the asset management fee, the ownership in the deal that gives you cash flow, and then the profit at the end. Now, the best part is that with a syndication, you can use other people's money to buying an apartment building. So you don't need any of your own money beyond maybe a $25,000 buffer I recommend for fees and incidentals. And more importantly, when you buy an apartment building, your money isn't stuck or tied up in this deal like with a flip or a single family rental or even a short-term rental. This is why if you only have, say, $25,000 or $50,000 to invest, you can scale with apartments and you're not going to get stuck with flipping houses or rentals. Let's talk about tax benefits. Really high, the highest it can be, because just like with traditional rentals, you do get some benefits from depreciation, but with multifamily real estate, you can get more depreciation sooner by doing something called a cost segregation study. I don't want to get into it, it's beyond the scope of this short video, but it's a tax strategy that allows you to depreciate about 60% of your investment within the first year. That's amazing. Now, that can go to offset the cash flow you make from the deal, where you pay potentially no taxes on any cash flow you get either. Now, there's other more advanced strategies where you can potentially offset your active income through real estate as well. And we can talk about that in another video. Also, other strategies that when you sell the asset, you can actually defer paying taxes forever if you do this. So there's a lot of really cool tax benefits of multifamily commercial real estate. Risk, I would say low to mid. There's always risk involved, but compared to the other ones, I think that multifamily is a lower risk because it doesn't, for example, suffer from single tenant risk, right? If one of your 20 tenants moves out, you're still making money. The market risk is lower. I like how multifamily performed over the past 5+ decades. For example, in the Great Recession 2008, it performed much better than any kind of real estate at the time. COVID surprised everybody. It performed very well during COVID as well because people always need an affordable place to live. So even in down markets, while there might not be hyper growth in the market, the demand for affordable housing is always strong. Now, I figured all this out in 2011 when I accidentally got into a 12-unit apartment building in Washington, D.C. that I bought with 5 investors. That was my first syndication. Now, it was a nightmare for the first 18 months because I didn't have someone showing me the ropes. I didn't have an advisor or mentor who had invested in apartment buildings, especially in DC. But after I figured it out, the property stabilized and started sending me about $1,500 per month in mailbox money. And that's when the light bulb went off, right? As you can see by what I went over already, apartment buildings are your ticket to becoming financially free over the next 1 to 2 years. In fact, it's the only way to become financially free with real estate. It's not with rentals and flips. So if you're interested in learning more, I recommend that you check out our Apartments 101 Masterclass. It's a free 1-hour training that shows you step-by-step process to purchase your first apartment building. And I'm going to show you some tips and tricks to actually do it in as little as 6 months. Now, in that training, you'll learn why apartments are, in fact, the only way to become financially free with real estate, and how to raise capital for an apartment building so you can get all the funding you need from private investors without having to beg your friends and family. No one wants to do that. And the secret to finding off-market deals, even if you don't have an apartment investing track record. Now, during this training, I'm going to tell you my story and how I lost basically all my money by making a couple of really dumb decisions in my pursuit of financial freedom. Hopefully that'll help you prevent those mistakes. So go to the Apartments 101 and check out the free training. Now, one thing to remember from this video is that there is massive opportunity in the multifamily real estate market if you get started right. Now, despite what you might see in the media, et cetera, the fundamentals of the real estate market are still strong, especially in multifamily housing. And that's because the demand for affordable housing is higher than ever, and the cost of new construction is through the roof. It's not getting any better. And as a result, America is currently short about between 3 and 5 million homes with no end in sight. So as a result, America is currently short between 3 and 5 million homes, depending on which report looked at. And there's no end in sight. There's no solution right now to getting the construction down and making it profitable for developers to make money on the lower end of the rent spectrum. Now, what's that going to do to rents, right? They're going to continue going up, and this is going to provide stable and growing income for investors who are in the multifamily space. And that's not even the best part, right? With all this uncertainty, there's opportunities to buy at a discount. According to a report by Newmark, $1.2 trillion of outstanding commercial real estate debt is potentially troubled, of which $600 billion is maturing around 2025, between now and 2025. And of that $626 billion in troubled debt, almost 31% is in the multifamily space. Now, according to Freddie Mac, multifamily matures, including bank originations, they totaled roughly $500 billion in 2024 and 25, which makes up about 42% of commercial real estate maturities for those 2 years. Now, a lot of numbers here I'm throwing at you right now. What I'm saying is there's going to be a lot of opportunity to buy some troubled assets of operators who didn't buy right and they didn't operate right. And this is really an unprecedented area where I think we're going to make millionaires within 12 to 18 months. It reminds me a lot of what happened in 2008 when there was a lot of distress and fear. And there's some people who bought in 2009, 10, 11, and 12. And that's amazing. So definitely want you to take advantage of this stuff. Don't be on the sidelines. Be afraid. Look for the opportunity right now. So I want you to head over to Apartments 101 and watch the free training. Now is really the time to get your training, start talking to brokers, start raising capital. At the end, if you're interested in getting my help to get your first deal done, you'll have an opportunity to book a call with my team and learn more about what we can offer and help you do your first deal and become financially free. So I hope you've enjoyed this video, and I'll see you next time.